Welcome back to Switzer. Turning now to high net worth individuals and how they invest their money. For a look at that, I've been joined in the studio tonight by John McMurdo from Centric Wealth, and they've done a survey of this recently. John, before we get to that, you heard the Finance Minister, so in a sense he's talking about your industry. And he made the point when I asked the question about superannuation people haven't been badly affected by the fall in resource stocks. But I would have thought a lot of self-managed super fund people would have disagreed and maybe thrown something at the television when he said that. What do you think?
Well, look, I suspect it's been one of the surprises for government, not only the number of people directly impacted by that change, but certainly, as you allude to, Peter, within self-managed super, but not just self-managed super, those in retail super funds as well. Certainly a degree of concern about that.
Yeah, because certainly if I was a superannuation fund manager and I've got my certain exposure to Australian stocks, it would have been tempting to be a little bit more loaded up towards mining, given the outlook we're expecting for mining over the next 5 years.
Well, for some that will certainly be the case, but therein lies, I think, the importance of diversification in your portfolio. So those advisors who have been able to make sure their clients are diversified won't feel that effect as strongly. Yeah.
What about his comments about the financial planning industry? You've been in the game for a long time. Are you happy with what the government's doing to change basically the product and service offering to clients?
Well, Peter, I have a very strong view that Australians deserve the benefit of high-quality financial advice. And so for a company like Centric Wealth that has built itself on principles of fee-for-service and the right ethical frameworks, as well as acting in the client's best interests, not surprisingly, we totally support and have been active in the support of the sort of measures that the Minister is looking to introduce.
OK. What about this survey now? You've surveyed high net worth people, and I'm sure viewers of this program say, well, how do you define a high net worth person?
Yeah, it's a good question. And look, there's a number of definitions, to be truthful. The definition used in this particular study, which conducted in-depth interviews with more than 1,600 high net worth individuals across Australia. It's a good sample size. The definition used there is $1 million of net worth outside of the family home and outside of superannuation. So quite a strong test.
Yeah, most definitely. So you've got someone who might own a home, they might have $1 million in super, but they'd have to have another $1 million outside in other investments.
That's the criteria.
Okay. So what do these sorts of people invest in?
Well, look, it's been interesting to observe, and the change even versus the same study done 12 months ago, where 12 months ago they were hoarding cash and being quite defensive.
They panicked themselves
a little of
cash.
that, and were quite defensive in their asset allocation. We've seen a noticeable swing to investors being much more opportunistic, and in particular looking to invest more in both international markets and what we would call alternative assets, assets like property trusts, infrastructure, private equity.
So their courage is coming back, because clearly 12 months ago a lot of people were going to cash. I know I had to talk to some of my clients and convince them not to go to cash because they'd copped on the downside. I wanted to get the rebound. Did you have the same sort of experience as well?
Certainly much more defensive 12 months ago, much more courageous and opportunistic now.
Yeah, OK. So what is their market view then? Because you actually did analyse the way they see the market's going.
Well, their market view is to be opportunistic. There's clearly what's underlying that behaviour is them seeing value in a number of asset classes and not wanting to miss out. So where they perceive assets to be relatively cheap, vis-a-vis where they were 12 months ago, they've been prepared to act on that conviction.
OK, give us a typical idea of a portfolio for this sort of person, because I'm sure my viewers would like to benchmark their own investments against what is the typical one that's coming out from the survey.
Yeah, of course. And look, it'd be fair to say up front there's no typical investment, because depending on...
It's the average feel I'm looking for.
Yeah, depending on a client's risk appetite, they may be more into growth assets or more defensive. But certainly an allocation to Australian equities, to international equities, and increasingly alternative assets, alongside bonds. But I think within the alternatives, as I said, there's an increasing exposure towards alternative and moving away from some of the more defensive assets.
Okay. how are you portraying property trusts, which have had a shocking experience? Are you trying to convince clients that because they've had a shocking experience, then the time is becoming closer, that the good experience will start happening, and therefore it's worth getting in now before the good times come and you miss that boat as well?
Yeah, well, look, we saw the early moves on listed property trusts, of course, and because they had liquidity, they were the ones first affected, and then unlisted naturally followed that and suffered some of that pain. Our view now is some value is being restored in property trusts. Of course, that doesn't go for all. As in any asset class, there's good properties that can be bought and there's lesser ones. But certainly versus 12 months ago, the fundamentals do look stronger.
Are you putting a time frame on when you think the solidity and the positiveness around property trusts will come back? Because at the moment, the question marks are there. Some people think they're big, some people think they're small. How long do you reckon before people will be kicking themselves for not being in property trusts?
Look,
good ones.
Yeah, look, as always, it's difficult to accurately predict. But our view is over the next 12 months, we'll see more and more of those who have been the early adopters and back into that. They'll become more prominent.
Okay. Before I go on and talk about international exposure, well, no, let's talk about exposure first, and then I'll talk about your wider market view, because once again, people will be wondering whether you think that there's a rally in store or another sell-off or correction, and then you might not want to answer the question, but you have to answer it for your clients. You must go into investment meetings and all that sort of stuff. I'd love to know what you're thinking. International exposure. These high net worth people, are they interested in going into Europe, for example, or are they more interested in the USA?
Well, look, it's been really interesting to
we all know they like Asia. We know that's not even a question.
Yeah.
But they're the two interesting ones.
Well, it's almost Asia first, daylight second, and then other markets. So in order, China, India, and then other emerging markets. So the BRICS type companies, Brazil, Russia, etc. Much less Europe, and still much less North America.
But you've been in the game for a long time. Could you imagine 10 years ago sitting up in a program like this and mentioning Russia, Brazil, India as a place where people want to invest?
Look, frankly, I think that would have been difficult for all of us.
Yes,
you'd share that view. Yeah. But just shows the pace of change in markets today, and hence the need to be aligned with a good advisor and a wealth firm who are tapped into that 24 by 7. And that's just vitally important in today's speed of change.
But what kinds of investment are you comfortable tipping your clients into in places like China and India? You just can't go in and just say any company has the same kind of transparency that we see, for example, in Australia. What kinds of investments make you feel more comfortable?
Look, it is difficult. I mean, I've spent time there on study tours, actually visiting companies and sites, and it is difficult. It's difficult to get the right access. I think it's hard to talk against the strength of the Chinese economy. That's very strong, but getting access to the right investments is all important. And that's extremely difficult for any individual investor and can really only be done through the right fund selection with people on the ground. And so I think the choice of advisor and the firm who can access those investments and weed out the ones that you shouldn't be invested in, that's all important.
Yeah. Are you finding as an advisor looking more at products like ETFs like never before, because the range and the diversity of ETFs are actually a lot better than, say, 5 years ago?
Well, that's been the key to it. ETFs, no question, are becoming more popular. And I think because they do give access to a range of markets where that wasn't possible previously.
Okay, what about the feeling about the international economy? Let's talk about the economy first and then the market expectation. What's your feeling and what are you telling your clients around the international economy?
Well, the international economy is a difficult one, and I'm not an economist personally. That's why we retain top economists in our business.
What are they telling you?
Yeah, well, our view is that we expect certainly volatility to continue. No question about that. There are trends for and trends against, but certainly we're talking to our clients about having a very active asset allocation which diversifies across a number of asset classes and takes away some of the volatility in particular markets.
Okay, for these typical high net worth people, what amount of their total portfolio is exposed to shares and what percentage is going to international?
Look, typically the exposure to shares, again, there's no typical client depending on their risk tolerance, but something in the order of 30-40% in shares, and a good amount of that in Australian equities because of the advantage of franking credits, as well as the strength of the Australian economy.
And because Aussie shares, particularly if you're going through miners, gives you a bit of exposure to the economies like China and India
as well.
It does.
It's a play on those markets without having to directly invest there. Okay. I agree.
The survey also gave you views on what the HNWs, high net worth people, think about advisors. What were the main conclusions?
Well, look, it's been really interesting to see it. I take the headlines from the research. High net worth clients are clearly telling us that, one, they use advisors much more than the general public do. And no doubt that in some way has aided them becoming high net worth clients. Second, that the satisfaction of high net worth investors with their advisors is very strong and in fact has actually increased during the period of the GFC. And then they're also telling us specifically what it is they value in their advisor, and for the first time are tangibly telling us how they differentiate between advisors, what makes a good one and what makes a poor one.
What does make a good one?
And look, if they rank 19 key issues in descending order of what makes a good one.
Not ripping me off, is that in there?
Look, it's in there. But if you take a step back from that, you can largely group those into four key buckets. The first is they want a trusted and an enduring relationship where trust is built over time. They want the right qualifications, experience and expertise of their advisor. They want to know that that advisor is backed by a strong portfolio construction and asset selection capability. And finally, they are really interested in impartiality, or as we would say in our business, sitting on the client side of the table, not being there to act on behalf of an institution or a product manufacturer.
Okay, we're running out of time, mate, but one last thing is that was there sort of a sensitivity that they thought that their advisor had to be a market tipster? Because that's one of the hardest things for all of us to do, to get the market right. It's really more understanding the goals and the circumstances of the client.
Interestingly, the high net worth investors absolutely understand that. They want their advisor to give good advice on strategy, on the structure of their investments, on cash flow management, on them being structured in a tax effective way, and be a long-term coach and advisor.
Okay. Thanks for joining us on the program, mate.
Great to be here.